Inflation is rising by record rates. We've seen inflation go from around 2 to 3% all the way up to around 5.4% in less than a year and a half. And there are a multitude of reasons why inflation is so high right now. One of those reasons is that supply chain issues are causing things to be more rare and people can't get a hold of the things that they want. That basically stems from the pandemic causing a lot of people to panic buy and demand for things to shoot up. Also, we saw a ton of stimulus being printed last year, which drove the value of our dollars down and made the price of things go up. But with all of this going on, Chair of the Federal Reserve, Jerome Powell, said that all of this inflation is simply just temporary. All of it will end up going away as soon as things return to normal. And just a couple months ago in August, Jerome Powell made a speech called Monetary Policy in the Times of COVID-19 that went over all of this inflation and how he and the Federal Reserve measures inflation on a grand scale. Jerome Powell laid out 5 measuring sticks that he and the Federal Reserve use to measure inflation levels. And today we're going to be talking about each of those 5 to see how they're holding up against what the Federal Reserve thinks. This will help us to see if this inflation is truly just temporary or if inflation like this is going to last for several more years. So make sure to stick around till the very end of this video to learn all 5 of Jerome Powell and the Federal Reserve's measuring sticks to measure inflation and to learn if inflation will stick around for the next year, 2 years, or even 5 years plus. But before we get into all of that, my name is Nate from the Minority Mindset News, and if you like this video, make sure to smash that thumbs up button below and hit that little notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. Inflation is the steady rise in the price of goods and services over time. Inflation is pretty much constant. Since we've had money, we've had inflation. That means the price of things goes up every single year, and the value of your money goes down. And now you're probably thinking, well, Nate, I actually still have the same amount of money, so how does the value of my money go down? Well, the actual buying power is what goes down. So if you have $5 today, it might not be able to buy the same amount of things with that $5 tomorrow. This is exactly why your grandparents could buy movie tickets, buy popcorn, and a drink for only around $1. Money itself had more buying power, but today that same movie ticket, popcorn, and a drink might run you $25 to $30. And for the most part, companies don't just raise prices to make more money. I mean, most of the time they raise prices in response to something. So for instance, in 2020, companies raised prices because things were in demand. The more of something that is in demand, the higher it is going to cost, especially if there's not a lot of it. Remember the toilet paper fiasco of 2020? Well, it was a scarce good, which means the price of toilet paper went way up. People couldn't get toilet paper, so when they finally saw some, they bought as much as they could. That's an item in high demand, which means the price is going to be high too. So inflation can affect an industry, but it also can affect an entire economy based on what the federal government does. So in 2020, the federal government printed trillions of dollars in stimulus. That made the value of our dollars go down because there's more money in circulation. Like I said before, the more people that have money, the less that it's worth. That's because more people can buy more things now because they have more money. So that means people are buying more things. And if people are buying more things, companies have to produce more. But they can't just produce more for the same amount of money. No, they actually have to go out and put more money into their system to produce more goods. This means supply costs. They also have to work on wages and they have to work on storing all of their new goods. Ultimately, that trickles down to the consumer, and your guac costs more now. Right now, it is no secret that inflation is at a record high, and it's the Federal Reserve's job to make sure that inflation doesn't get too high. And if inflation does get too high, then the Federal Reserve steps in and works with the Treasury to make some monetary policies. Monetary policies to help stimulate the economy. But right now, Jerome Powell believes that this level of inflation is purely temporary. He even said in that speech that this level of inflation will only last until around 2022. And to make sure inflation is not getting too high, Jerome Powell has laid out 5 different things that he uses to measure inflation and also to predict where it's going in the future. Basically, what he means is this. Is the entire economy affected by this inflation, or is it just specific sectors? And this is hard to measure because you have to look at almost every single industry within the United States. You have to look at energy, you have to look at consumer goods, you also have to look at investments like stocks and also commodities like gold. In addition, all of this needs to be tracked so that you can see the trajectory of what inflation is going to look like. Right now, most of us know some pretty big things that are being affected by inflation. This is goods and services. Everything that we buy at the store to everything that we use is going up in price. The biggest reason for this is due to supply chain issues around the world. People have a high demand for certain items right now, and they can't get those items, which means they are very rare. And in addition, these companies can't produce items fast enough for people to buy. That means it's hard for them to make, and a very highly sought after item, which means the price is going to go up. For Jerome Powell and the Fed, this is completely temporary. Once the supply chain issues subside and companies are actually able to produce more goods, demand should start to go back down. And once demand and the supply of things hit an equilibrium, you'll see the price eventually reflect that. So in this case, things should go back to normal. And right now we're seeing a lot of consumer prices go up, but overall, we're not seeing everything rise right now. The second thing that Jerome Powell and the Fed look at when it comes to inflation is how long inflation has been around. Are prices continuing to go up, or are they starting to teeter off and drop? For instance, we had the toilet paper fiasco of 2020. I know I already mentioned this before, but back then people could not get toilet paper. That means the price actually went up. But eventually, that went back down, and the price of toilet paper has now returned to normal. In a lot of industries, we're seeing the price of things go back to normals, particularly in the durable goods industry. Durable goods would be something like cars. If you tried to buy a used vehicle over this summer, then you would actually pay more than what the vehicle was really worth. This is because used cars essentially lose value the second they're taken off the lot. But because nobody could get new cars, they were turning to used cars. So the market for used cars was going way up. That meant the value of used cars was skyrocketing. Those prices are beginning to drop from their all-time highs. This leads Jerome Powell and the Federal Reserve to believe that this biggest spike of inflation that we've seen has already passed, and things should continue to lower from here. The only reason inflation rises so quickly is because there's a force that actually makes it rise that fast. Like I said last year, it was supply chain issues and a ton of stimulus. If there's nothing there to make it rise, then inflation should go at least back to normal. The third thing that Jerome Powell looks at is wages. How fast are wages rising in comparison to how much companies are making and how much they're producing? Over the last year or so, wages have risen across the country. This is mainly in response to inflation in general. As things cost more, companies have to pay their employees more so that way they can meet that new cost. And while wages have gone up by a little over 3% over the last year or so, that's not a big leap from where they were going up before. On the flip side though, if wages do begin to increase faster than the production levels of companies, this could be very bad for inflation throughout the country. Companies will have to pay their workers more, but they're not making enough money because they're not selling enough products. And if they're not making enough money because they're not selling enough products, then they can't give the workers more money either. This could create a huge problem with companies and could send some businesses into bankruptcy. The only way to respond to this is for companies to raise their prices more, which would cause consumer goods to go up even more. So inflation is kind of like a rotating circle. The fourth thing that Jerome Powell and the Federal Reserve look at is what are the current expectations for inflation around the country. This is a little harder to measure because it actually looks at what people are doing with their money. If people are starting to behave differently with their money and are very scared about the direction that inflation could be going in, then this could lead the Federal Reserve to act accordingly. What I mean by this is, how do people actually interact with money? If they need a loan to buy something, what is the interest rate that they can expect to get? If that interest rate is way too high, then you'll see a lot more people stop buying things, or at least stop getting loans. This means a lot less buying of things, which ultimately hurts our economy. And the fifth and final thing that Jerome Powell and the Federal Reserve use to measure inflation is to look at inflation on a global scale. What are other populations doing with their money, and what does technology look like within the labor force? As we all know, advancements in technology have eliminated some jobs, and if you don't have to pay somebody at a job, then you're technically saving money, which means there's less money in circulation. Another thing they look at is the actual age of populations. If people are spending money less because of what age they are, and there's less money being put back into the economy. And if there's a lot less people, then there's a lot less need for money in general. Even through the pandemic, these technological advancements and populations never really changed. This has been constant throughout the last year or so. So as long as globalization continues at its same rate, the Federal Reserve believes that inflation could begin to drop as soon as 2023. And while it's not a perfect system, these are the 5 things that Jerome Powell and the Federal Reserve use to measure inflation and to predict where it's headed in the future. This all helps the federal government to create monetary policies and to hopefully keep our economy afloat. But now I want to hear from you on this issue. How do you think these 5 measures are stacking up against the current levels of inflation that we have? Do you think these 5 measures help us to accurately predict inflation, or should the Federal Reserve and Jerome Powell be looking at something else? In addition, do you think that this current level of inflation, which is currently at around 5.4%, will continue through the rest of this year and 2022, or do you think within the next few months it could begin to drop? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, don't forget to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.